Let's talk a little bit about, and I'm going to jump around a little bit, but let's talk about the 2018 tax law. And what happens is basically when Congress passes a new tax law, the IRS then has to issue what they call their regulations. And that's just another fancy word for saying it's their interpretation of the tax law. And sometimes it takes a really long time for the IRS to kind of issue their regulations as to what their interpretation is. Keeping in mind that their interpretation doesn't mean that they're correct. It's just their spin on the tax law. Consequently, if there was something that was somewhat ambiguous in the tax law, hey, if I'm your CPA, we're going to take an aggressive position. We're going to do what we think is best for the client, and that's the way it goes. Okay. So this new tax law was probably, well, it is. It's the first big change in tax law since what year? This is where I ask everybody the question. Does anybody remember what year the last big tax law change was? Probably got to be someone a little older. How about 1986? The Tax Reform Act of '86. A lot of new changes then. This is the first big tax law change since then. And as I said, I think at the last McPhee seminar, I look at this like the Clint Eastwood movie, the good, the bad, and the ugly. Because the truth is, there's some really good stuff in this tax law, and there's some stuff that's kind of in the middle, and there's some stuff that's probably not so good for some people. It depends. It depends on where you are. Let's talk about the good stuff. Everybody know that one of the good things that happened is that the tax rates and the highest rate has changed, where the highest individual rate used to be like 39%. Anybody here win at 39%? Because if you are, I'm available for adoption, okay? I'm just saying, well, now it's down to 37%. So the highest rate dropped, and also all the brackets changed too. So the truth is, if you did your own tax return, even on TurboTax, I don't know this for sure, but most tax softwares already have built in. They'll take your tax return for the current year, and they'll flip it into the 2018 tax law. It's not going to tell you everything, but it may give you some idea as to how you would fare in 18. That's based on the change in brackets, the change in rates, and some deductions, which you may lose. Okay, so that's a really good thing. Most people are interested in capital gains. They pretty much stay the same. Capital gains are a good thing. I'm just saying, we like capital gains. Another thing that really is going to help business owners out, there's a new code section, and I think it's 199 if you like throwing code sections out. And basically what it says, if you're in business for yourself, instead of having to report 100% of your income, you only have to report 80% of your income. Now, there's a couple caveats to that, and there's some exceptions. But the general rule is, if your business made $100,000, let's say, and say in 2017, you had to report $100,000 as income, well, in 18, you only got to report $80,000 as income. That seems like a pretty fair deal. Would you not agree? And that actually is going to apply whether you're in business either as a corporation, well, as an LLC. So if you're in business and you file a subchapter S return for yourself, it's going to apply. And it even applies if you're a sole proprietor. And we're going to talk a little bit about structuring and sole proprietorships. We don't like them. You pay too much tax. But the bottom line is there are some exceptions to that 20% rule. But for the most part, I think most people are going to be able to take advantage of this. It's a really good thing, okay? Let's talk about some other things that changed. They tried to kind of eliminate a lot of itemized deductions. And conversely, they increased people's standard deduction. So like if anybody's a W-2 employee and you've claimed like employee business expenses in the past, they're gone. No more employee business expenses. Most casualty losses are gone unless you live, I think, in a state of disaster area. Here's one that would have killed me. They did away with this deduction for alimony. You know how many times I've been married? That was a great deduction, okay? Well, guess what? And also, the interesting thing is when people got divorced, that deduction actually became part of the negotiation. Because if I'm getting divorced and I can settle my divorce with the wife and pay her alimony and I get a deduction for it, that's a good deal for me, especially if I'm in a high bracket. And I think the government figured out on that one that basically generally the person paying the alimony was in a higher bracket, and the person receiving the alimony was in a lower bracket. So pretty much the government was getting beat on that one. But no more alimony deduction. I'm telling you, that's not good. We like it. Well, we don't like having to pay it, but we just like being able to take the deduction. Okay, so that was another big thing that went out. But here's I think the one area that I think is going to affect people the most, and it's kind of tied in with the idea that they really don't like people itemizing their deduction. Well, let me step back. One other quick note: mortgage interest. In the past, most people probably this didn't apply to, but if you had mortgage interest on your personal residence, and the mortgage was more than $1 million, did you know that you couldn't take all the interest deduction? $1 million was the cap. So if you had $3 million in mortgage interest on your home, you really can only get the mortgage interest deduction on $1 million. Well, now they dropped that to $750. Sorry. And by the way, that's for new mortgages. I believe if you already have the mortgage, the grandfathered in. But the biggest item we refer to as salt. Everybody know, I'm not a doctor, but I think salt's not supposed to be good for you, is it? I think it's bad for you. I'm not sure. SALT stands for state and local income taxes. So in the past, say you were someone who lived in California. Anybody here from California, by the way? We have so many clients from California, it's unbelievable. You'll be my neighbor by this time next year, trust me, when you see what happens, okay? So I'll use California as an example, but it's not just California. I came from New Jersey, high income taxes, high property taxes. New York, same thing, Illinois. So in the past, what would happen is on your federal tax return, you would get a tax deduction for what you paid in state income taxes and in real estate taxes. Well, California has high personal income taxes, and they have really high real estate taxes. So some people and remember, you have to, in many cases, you have to make a lot of money in California to be able to live in California because it's so expensive to live there. So, you can have someone who's paying $50,000 a year to California between state income taxes and real estate taxes. That's no big deal. Well, in the past, of course, you get to deduct that on your federal income tax return, right? So effectively, the federal government is subsidizing those taxes because let's make believe, I'll use an even number because I'm really not good at math. But let's just say there really was a 30% bracket. There's not, but I'm not good at math. So if you were in the 30% bracket and you paid California $50,000 a year, 30% times $50,000, you save $15,000 in federal income taxes. So effectively, the federal government was subsidizing you paying your state income taxes and your real estate taxes. Well, guess what? It turns out the people who lived in those states did not vote for Don, okay? And so one of the new tax laws is that deduction is now limited to $10,000. So if you had been paying them $50,000 in the past and taking a deduction for $50,000, guess what? $10,000. And to top it off, remember that was just part of your itemized deductions. So now that's capped at 10. They eliminated all miscellaneous. You probably have hardly anything left after that because usually, taxes is probably the biggest deduction on your Schedule A. Now, they did increase the standard deduction, but I'm thinking in the best case scenario, if you live in one of those states, keeping in mind that the rates became lower, but now you lost that deduction, I'm thinking if you broke even on this deal, that would still not be a bad deal. But I don't know that you're going to benefit out of this because you're losing that deduction. As Donald Trump would say, that is a huge deduction, okay?